December 18, 2025. The winter air hangs sharp and metallic over lower Manhattan. Steam rises from subway grates along Broadway, curling into the shadows of glass towers that reflect a pale, uncertain dawn. Inside trading floors, screens glow before the sun does. Red and green numbers flicker in silence. No panic yet. No headlines screaming catastrophe. Just a quiet tension. At this exact moment, nothing appears broken. The S&P 500 still trades near record highs. Corporate earnings look resilient on paper. Banks report adequate capital. Unemployment remains low. Official statements insist the system is stable. And yet, beneath the surface, three alarms are sounding at the same time. Not alarms you hear. Alarms embedded in balance sheets, in interest rate curves, in valuation models no one looks at during bull markets. This is the paradox at the heart of the modern financial system. The moment of maximum confidence is often the moment of maximum fragility. History has taught this lesson repeatedly. In 1929, optimism peaked just days before collapse. In 2007, housing prices had never fallen nationally. In early 2020, risk models assumed pandemics were statistically irrelevant. Each time, the system broke not because people expected disaster, but because they couldn't imagine it. What makes 2026 to 2027 different is not that another bubble exists. It is that every major asset class is inflated simultaneously, tied together by a single invisible force: cheap debt. And cheap debt is gone. For 14 years, the global financial system was built on one assumption: that money would remain close to free forever. Central banks slashed interest rates to zero, then below. They printed trillions. They purchased bonds, mortgages, equities, rewriting the laws of finance in real time. It worked. Until it didn't. This documentary is not about a market crash in isolation. It is about a system that quietly rewired itself around leverage, and now must unwind. To understand how we arrived here, we must go back, not to 2025, but to the aftermath of 2008. When the global financial system nearly collapsed, policymakers made a decision that would define the next generation. They chose stabilization over liquidation, rescue over reset, debt over default. Interest rates were cut to zero. Quantitative easing flooded markets with liquidity. Risk was not removed, it was transferred, expanded, and normalized. Corporations learned they could borrow endlessly. Governments learned deficits no longer mattered. Investors learned that central banks would intervene whenever markets fell too far. This belief, often called the Fed put, became the foundation of the everything bubble. Stocks rose because earnings were engineered with debt. Real estate surged because mortgages were artificially cheap. Bonds soared because central banks were the buyers of last resort. Private equity thrived on leverage. Cryptocurrency emerged as a speculative mirror of excess liquidity. Each asset class reinforced the others. By the early 2020s, this system was no longer flexible. It was rigid, brittle, dependent on rates staying low forever. Then inflation returned. Central banks were forced to raise rates, not gradually, but violently. The fastest tightening cycle in modern history shattered a core assumption embedded across trillions of dollars in contracts: that refinancing would always be cheap. The consequences of that shift do not arrive immediately. They arrive on maturity schedules. And those schedules converge in 2026 and 2027. This is where the architects enter the story, not villains in dark rooms, but rational actors responding to incentives. Central bankers who believed liquidity could substitute for discipline. Corporate executives who replaced investment with financial engineering. Asset managers who built strategies assuming perpetual stability. Politicians who borrowed against the future to preserve the present. No single decision caused what comes next. It is the accumulation that matters. In the body of this documentary, we will trace how stocks, corporate debt, commercial real estate, banking balance sheets, and passive investment systems are mechanically linked. How stress in one triggers collapse in another. We will examine why diversification fails when everything is priced off the same interest rate assumption. Why margin calls, refinancing cliffs, and forced selling create feedback loops that no central bank can fully stop. And we will confront the most unsettling truth of all. This time, there may be no safe haven. The architecture of a compounded collapse. The illusion of stability. In late 2025, surface indicators suggest resilience. GDP growth appears steady. Corporate earnings, while slowing, remain positive. Financial television reassures viewers that markets have absorbed higher rates. But beneath these metrics lies a structural mismatch between asset prices and financing costs. The modern financial system does not collapse from losses alone. It collapses from inability to refinance. And refinancing is the central risk of 2026 to 2027. Between 2020 and 2021, corporations issued trillions in debt at interest rates between 2 and 3%. This debt financed stock buybacks, acquisitions, and speculative expansion. It did not build resilience, it built dependency. By 2026, nearly $5 trillion of this debt matures. At current rates, interest expense doubles or triples overnight. For highly leveraged firms, profitability disappears not gradually, but mathematically. This is how solvency crises begin, not with falling revenue, but with rising costs that cannot be offset. Stocks, valuations without cushion. The stock market reflects this fragility. By historical standards, valuations entering 2026 remain extreme. The Shiller CAPE ratio near 39 implies future returns are already pulled forward. There is no margin for error. Earnings compression alone, without recession, forces repricing. And repricing triggers margin calls. Margin debt, once a footnote, becomes a catalyst. As asset prices fall, leveraged investors are forced to sell, pushing prices lower, triggering more forced selling. This dynamic is not psychological, it is mechanical. Passive investing and automatic deleveraging. Unlike past crashes, a significant portion of today's market is controlled by passive vehicles. Index funds do not analyze value. They do not pause. They sell when investors redeem. As volatility rises, risk parity funds, volatility targeting strategies, and options hedging models all reduce exposure simultaneously. This creates a market where selling accelerates regardless of fundamentals. Liquidity disappears precisely when it is most needed. Commercial real estate, the silent fuse. Commercial real estate enters this cycle already wounded. Office occupancy never recovered post-pandemic. Values declined, but losses were not realized. Banks marked assets to optimistic assumptions, extending loans rather than recognizing impairment. In 2026, those loans mature. Refinancing at lower valuations forces write-downs. Equity is wiped out. Banks face capital shortfalls. This is not a repeat of 2008 housing. It is something more contained and more dangerous. Concentrated institutional exposure. Banks and credit freeze. As losses surface, banks respond predictably. They stop lending. Credit contraction spreads to small businesses, consumers, municipalities. Economic activity slows, not because demand vanishes, but because credit does. This is the moment when a financial crisis becomes an economic one. Why central banks struggle. In previous crises, rate cuts stabilized asset prices. In 2026, rate cuts collide with inflation credibility and currency confidence. The balance sheet is already bloated. The tools that once shocked markets upward now produce diminishing returns. Liquidity no longer solves solvency. Every era of finance ends the same way, not with a bang, but with a realization. A realization that the rules people believed were permanent never were. In the final months before 1929, economists insisted markets had entered a new era. In 2007, bankers argued that financial engineering had eliminated systemic risk. In the early 2020s, policymakers believed liquidity itself was stability. Each belief collapsed under the weight of reality. What makes 2026 to 2027 different is not that history is repeating, but that history has been layered on top of itself. Debt upon debt. Intervention upon intervention. Leverage upon leverage. For more than a decade, the global economy replaced organic growth with financial compression. Risk was not destroyed, it was deferred. Losses were not eliminated, they were warehoused. Volatility was not solved, it was suppressed. And suppression always carries a price. The everything bubble was never one decision or one policy. It was a system quietly trained to depend on conditions that could not last forever. Low rates became permanent assumptions. Rising asset prices became necessities. Refinancing replaced repayment. Liquidity replaced solvency. The moment rates normalized, the architecture began to strain. And now, as refinancing cliffs approach, the system faces a test it was never designed to pass. Not because people acted irrationally, but because incentives rewarded fragility. Corporations optimized balance sheets for cheap capital, not resilience. Investors chased yield in a world where yield no longer reflected risk. Governments borrowed against future stability to preserve present calm. Central banks learned to treat markets not as signals, but as patients to sedate. For years it worked, until inflation returned and exposed the cost of control. What unfolds in 2026 to 2027 will not feel like a sudden collapse. It will feel like a sequence of disappointments, earnings misses, refinancing stress, asset write-downs, cautious lending decisions. At first, nothing dramatic. Then everything at once. Markets will not crash because investors panic. They will fall because mathematics leaves no alternative. Interest expense rises. Cash flow tightens. Valuations compress. Leverage unwinds. Liquidity vanishes. This is not fear, it is arithmetic. And arithmetic is unforgiving. In past crises, diversification offered escape. Bonds rallied when stocks fell. Gold rose when currencies weakened. Real estate held when equities collapsed. This time, those correlations break. When everything is priced off the same interest rate foundation, everything reprices together. That is the defining danger of the everything bubble. Not loss, but synchronization. The pain will not be limited to speculators or institutions. It will touch retirement accounts, pension funds, municipal budgets, university endowments, and household savings. Unlike 1929, ownership is broad. Unlike 2008, leverage is systemic. Unlike both, central banks begin this crisis already extended. This does not mean the system ends. It means it changes. Financial history moves in cycles: expansion, excess, correction, reform. The post-2008 era prioritized stability at all costs. The coming era will prioritize credibility, discipline, and constraint because it must. Every crisis redraws boundaries. After 1929 came regulation. After 2008 came intervention. After 2026 to 2027, the question will be whether societies choose restructuring or repetition. That decision will not be made by markets alone. It will be made by policymakers, institutions, and individuals confronting uncomfortable truths about debt, growth, and risk. The everything bubble is not a story of villains or conspiracies. It is a story of incentives, and what happens when incentives reward short-term calm over long-term stability. When this period is studied years from now, the warning signs will appear obvious in hindsight. Valuations detached from cash flow. Debt detached from earnings. Asset prices detached from reality. But clarity always arrives late. The purpose of understanding this moment is not fear, but awareness. Awareness that systems built on leverage demand humility. That intervention has limits. That financial engineering cannot replace economic fundamentals forever. And that every generation learns again that risk never disappears. It only moves. As the everything bubble unwinds, markets will search for a new equilibrium, one grounded less in liquidity and more in value, less in leverage and more in resilience. The transition will not be painless. But history shows that from correction comes clarity, and from clarity, reform. What matters most is not predicting the exact timing of collapse, but recognizing the structure that makes collapse possible. Because when systems are understood, individuals are no longer blind participants. They become observers capable of caution, preparation, and perspective. The everything bubble is not the end of capitalism, nor the end of markets. It is the end of an era that believed price stability could be engineered without consequence, and the beginning of one that must confront reality again. Not dramatically, not emotionally, but inevitably.